All right, welcome to our Forex class series again on the 30 days boot camp. This is your second class, and it's happy to see you here again. All right, so I'm Joseph Samuel, and this second class we are going deeper into the real mechanisms of Forex trading. In the first class, we discussed what forex, how the forex market works, what pips mean. We talked about trading sections and the role of brokers and trading platforms. Now we're about to get into building blocks that determines your profit, risk, and trade size. Okay. Um, before we today's class, we're going to cover lot size, we're going to cover leverage, margins and how it works, risk per trade, stop loss, take profits, risk to reward ratio, and of course, let's say trading psychology. So, this is a 30 days boot camp. And like I said earlier, we're going to be discussing the lot size, the leverage, margin, risk management, and some other aspects. So, what is lot? As in, what do you mean by lot? Okay, sorry to say, one of my friends told me sometimes, I said, what do you even know by lot? They say, lot is Abraham's brother. Now, I said, guy, what's the problem? It's not about Abraham's brother. This one is in Forex trading, okay? Lot is this unit of, let's say, the standard unit of measurement used to represent how much of a currency pair you are trading. Okay, so how much of a currency pair you are trading, that's what loss is. Just a standard unit of measurement used to represent how much of a currency pair you are trading. Let that one sink into your head, because if you don't understand lots very well, you might not be able to manage your capital effectively, and that's why most people actually lose money, or because the lot has to do with how it affects your greed. It affects your profit and it affects your loss. So it's a one major aspect of forex trading. So whether you're a beginner or you're an advanced, intermediate, whatever, understanding lot size is very, very essential. Many times you have heard that people will say, I'm trading with one lot size. So when they tell you I'm doing one lot size, oh, I use 0.5 lots, I use 0.01 lots. Those are telling you the amount of something they used to go and buy, or they purchase the market. Okay, so there are four major types of lot size. We have the standard lot, which is the one lot size. This one lot size means it has 100,000 units. Then we'll break them down. Okay, we'll break them down. Mini lots have to do with 10,000 units, which is 0.1. While 0.01 is the micro lots. Then we have what is called nano lot, though it's not that common in most trading, but still people still use it at times in some brokers, which is 0.001. Okay, more so common, maybe you are trading synthetic markets at times, is very, very common in all of those aspects of trades. So when somebody says I'm trading with one lot size, and I said that one lot size also means 100,000 units. So that means, let's say you are trading with one lot size of Euro USD, for instance. That has to do with 100,000 units of Euro USD. That means the person is who said I'm trading Euro USD with one lot size means is buying 100,000 units of euro. Then we'll talk about the base currency and quote currency. Now, the base currency is what your immediate action actually affects directly. So if I say I'm buying Euro USD, that means I'm buying Euro. That is what it just means automatically. It means Euro and USD, they are actually in a battle of who is rising and falling. And I said I'm supporting Euro. So that is what it just means. I'm supporting Euro. Despite the fact that there are two people on the game. Nothing concern me specifically with the second person. Who I'm supporting is Hero. We play match now, we watch football. Man U against Chelsea. And I said I'm supporting Chelsea. I'm supporting Man U. So irrespective of whatever the outcome is, I've made my decision that this is who I'm supporting. So if the person fuck up, it affects me. If the person wins, it also affects me psychologically, either way. So that is the relative to what it means. So when someone said I buy Euro USD with one lot size, it's actually buying 100,000 units of Euro. Please take note of that. And if it's trading with 0.1, I guess you know that one mean. That means it's buying 10,000 units of, for now we have 0.1 GBP USD, right? That means it's buying 10,000 units of GBP, which is the pounds. Okay? And if it's trading with 0.01 lot of USD JPY, that means it's buying 1,000 units of USD. So it's just a confluence with another peer, because we don't trade the what is it called? The Forex market in isolation. All right, so we'll move on to leverage. What is leverage? Leverage is what allows you to control large trades with small capital. You know, earlier on I told you that your on the previous class, I said that your broker is the one that stands between you and the financial market. So now you don't have billions or trillions of naira to go and trade the market. $5 cannot actually trade the market. Yes, so the broker brings you into a leverage, and once you are opening your account, they will ask you what leverage you want to be on. Means that at what level should we ask, can I assist you with? So I say, okay, assist me with 100 leverage. That means for every $1 I bring into the market, the broker will tell me that they are multiplying it by 100. So that implies the fact that if I have $5, that means the market is seeing me that I'm not trading with $5, I'm trading with $500. That means I'm controlling $500. That's what leverage does for you. So leverage is what allows you to control large trades with small capital. So it's like trading with borrowed money from your broker. So it's like trading with borrowed money from your broker. Just like I explained earlier, I have $5. That's all I have to trade the market. But I went to meet a broker who has large amount of money, and they told me that, okay, how much do you wish to borrow? Whatever amount, how much do you have? Let me see how much you have before I can help you out. Okay, you said I have $5, and they said, okay, so I'm giving you an option. Should I give you times 50, or should I give you times 100, or should I give you times 1,000? I know many of us would like to go to maybe times 1,000 leverage. Yes, actually very cool. It's actually very cool. Large leverage is good when you know how to use it very well. When you master your trading, your strategies, your entering model and the like, it's very good because you will make more profits with larger leverage. But at the same time, you can also make large losses because leverage can help you multiply your profits, but at the same time, it can also help you multiply your losses. So you must be careful while you are using leverage. Don't let the greed factor tell you that I want to have higher leverage so that I can make more profits. No, you must understand that at average, 1:100 is still a very good reasonable leverage. If you have $10, you are trading with $1,000 in the back-end portfolios. Okay, so these are some examples like I've explained earlier. $100 with a leverage of 1:100 means that the person will have $10,000 at his back end. You will not be seeing $10,000 in your account, oh. So take note. But you'll be seeing $100. But at the back end of the program algorithm, what the financial market is seeing that you're using to trade is $10,000. But you are seeing on your possible on your MT5 or in your own dashboard, you will only be seeing $100. Now, somebody who is trading with $200 with on a leverage of 1 to 500, that means the person is trading with a back end of $100,000. And somebody who is trading with $500 with 1:50 is trading with $25,000. You are seeing it now. So, and somebody who is trading with $1,000 with a leverage of 1 to 20 is trading with $20,000. So it's not about, you can see how the leverage relatively impact the amount that the person is bringing into the trading portfolio. You can see here, for instance, now somebody who is trading with $200, but it's on higher leverage of 1:500 is having $100,000. And I feel like, and somebody, you better be able to open multiple positions more than somebody who is trading with $1,000 and is open and is on a leverage of 1 to 20. So that is how the contrast was. So the higher the leverage, um, the less the margin is required, but the higher the risk. So you now be asking me now, what is margin? So let's go on. So what is margin? Margin margin works in hand in hand with leverage. So margin is the amount of money your broker require for you to have in your account to open a trade. So margin is the amount of money your broker require from you, sorry, to have in your account to open a trade. It is not free. It is just a deposit aid while your trade is active. Okay, while your trade is active. That's why I wrote some types of trades margin here. We have what is called required margin. Required margin means how much is needed to open a trade. For instance, I have $100, right? And I want to open a trade that is possible. I want to open a trade with, let's say, one lot size. I cannot, because possible I'm on a leverage of 1:100, whichever way. I cannot still open with one lot size. That's a very high risk. The broker also don't want to run into losses. They also want to make their own profit. So they will want to feel safe. So they will hold some of your capital and say, okay, just if despite the fact that we give you leverage, we'll still need to hold some of your capital so that you don't just over leverage and misuse the opportunity we give to you and be trading anyhow and waste our capital, our money. Okay, so we have what is called use leverage. Use leverage has to do with the total margin currently in use. That means when you open a trade position, when we are dealing with um, trading tools like MT5, um, you will sit there, will sit on your dashboard, the margin will open trade positions and you will see. So that's going to be in the next class. You will see how to, you will see the margin, you will see the required margin, free margin, and margin level, right? So now, we said is the use margin is the total margin currently in use. So once you open a trade position and your trade is running, that amount of loss that used to open that position, that trade that is currently running, is what we call the used margin. Okay, you have used certain amount from this. Then we have what is called free margin. Now, free margin is the money left to open more trade position. You know, sometimes for experienced traders, some people like to do, you want to open more than one position when they are trading market. So if you have $10 in your account, for instance, you don't want to open more than one position. But now, assume you now want to open, irrespective of the leverage you have, let's assume you have 1:100 leverage. So that means at the back end, the market is saying $1,000, right? So if you now open one position, two positions, you know, when you want to open the third position, for instance, now depending on the lot size you are using, assume you are using, okay, you are going to be using the minimum lot size, which is 0.01, to open, let's say, Euro USD, for instance, and you are open the first, second position. When you want to open another third or fourth position, the market will not allow you, even if your entering is correct, the market will not allow you because you are already running on over leverage. And at that point, they will not want to risk their money, their own accounts too. So, or they would not also help you to jeopardize your account. Of course, the brokers are also friendly with you. Okay, so the money left to open more trading positions. But the thing is, the more profits you have, your margin value will increase. So even if I have $10 and I'm on a trade and my profit is reading $5 profit already or $10 profit already, The market will see it at the fact that I already have what is called additional margin, additional margin, so that margin now we now need to um me to open more, give me more room to open more positions to trade the market. All right, so what was called margin level. Margin level has to do with the percentage that tells how healthy your account is. Now, when you are running low on margin, there's what we call margin call. Margin call. The broker will send you a message and tell you that, hey, you are running low on margin. That means your account position is already getting close, and we advise you that you either close your trade position so that you don't run off all total capital, or you leave it and let it go. But that's just a margin call. So how healthy your account is what called the margin level. So the margin has its own formula, and it's given by lot size times the contract size divided by the leverage you are in. When I'm talking about contract size, we have to do with we talked about the fact that one lot size is 100,000 units, right? So that's what we call contract size. So when you want to get your required margin, though you manually will not be calculating all of these things, it's not really necessary, but it's actually good to know the state of your health of your account. Okay, at times. All right. So you have 0.1 at 1:100, for instance. Now at 1:100, that means 10,000 units divided by 100, which is the leverage you are. That means your margin is what, $100. So if you are running on 0.02 lot at 1:500, that means, remember, the 0.01 lot, that means the contract there is what? That's 1,000. So we have it as 1 divided by 500. Understand? That gives us $2. So margin levels, we still the same thing I've explained earlier. So we have it as equity divided by the used margin times 100. So let's say your equity. Your equity is the amount of money you have to trade the market, right? That's your own capital that you funded. That's what we call equity in the market. So if you have, let's say your use margin is 100, let's say $100, that means your margin percentage is $400. That means your account is still healthy. We know talk about percentage, margin percentage, right? That means telling about the health of your account. Okay, so any margin that is below 100%, that's when you will have the margin call that your broker will definitely call you, and that will lead to either you close your account, or if you are sure of your position, you leave it and market stay on your direction. So the higher the leverage, lower required margin, but also higher risk. I've told you that earlier on. So always calculate before placing trade. That means you calculate your lot size before placing trades. But the best, if you don't want to calculate at all, always stick to the minimum lot size. No matter the amount you have, at least for a beginner now, even if you have $1 million in your account, okay, it's safer to use minimal lot size, that's 0.01, to place a trade, to build confidence, to build confidence while you actually trade. So this is margin tips summary. Talked about lot size, leverage, required margin. All right. So risk per trade. You don't want to risk so much of your account. No matter how much or no matter how perfect a trading strategy might be, it is still on the verge of doubt. That means it's still open to market manipulation. That's just the truth. You are not 100% certain on any strategy. I need to be open and real to you. Okay? It's actually a probability, but you want to have the higher probability that market will go in this direction. And no matter how high your probability is. You still don't want to play with your hard-earned money. You don't dash out your money to the broker or to the financial market. You want to make sure that you are properly protecting your fund. Okay, so the proper risk management is between 1 to 2% of your capital per trade. Of course, for some of us or for some people who will be trading with as low as $10, because I will not say if you can trade with $10. That I will not say you cannot trade with $10. You can trade as low as $10, even $5. Why people trade with $5? Okay, but it's just that it's risk. You will not be. It's very risky. You might end up blowing it multiple times. Okay, because it's very small, and no matter the leverage they are still giving you, it's still not worth it to trade with that small amount of capital. So if you are trading with, let's say, $100, now be realistic, $100, but let me just go with 100 or $10. It might be impossible for you to if you are trading with $10 rather, it might be impossible for you to risk 1%, meaning that having a stop loss of 1%, that means $1. It's that 1% means that's 1/100 times 10. That having a stop loss about that's by $0.01 or $0.1. It might be nearly impossible, okay? But this is just the average calculation that on a $1,000 account you are risking $10 or $20 max. Any risk below 20, 30, $40, you are what's called over leverage or over risking. Okay, so and that will help you to actually prevent your account from blowing. A lot of people blow account because of poor proper risk management. And at the end of the day, they will tell you that Forex is scam, Forex is this, and they shop outbreak. Yes, for us to give you outbreak, there's no doubt without it. You will lose money. I will not point out you will lose. As far as you are just coming to the business, but be ready to that's why you have be ready to take the what's it called? The proper training and the skill, implement it. Practice with your demo account effectively before you come into the real account whereby your emotions is now be attached, because in most cases your emotion may not be attached while you are trading demo. You might just open trades and just do trades anyhow. Okay, but still you have to be careful of losing your hard-earned money. We've talked about this risk per trade. This is still example. At $500, I'm risking 2%. That means I'm only losing $1 or $10 for the market. And I have $100 and I'm risking 1%. That means I'm just having a stop loss of $1. So I'm having that repeatedly. That is how the calculation goes. Stop loss and take profits, very essential. Very essential. You cannot be a trader without a stop loss and without a take profit. They said no matter how far you go, if you go in the wrong direction, you will never head to the right path. That's what stop loss and take profit does for you. They limit how loss, if you feel like the market will still come back to my direction, so you leave your market without stop loss, market may not come back to you. It will just keep going till your account closes. And when your account now closes, it will now come back to your direction. So stop loss help you to limit your loss. So if market goes against you, like I said earlier, you cannot be 100% correct in your analysis. Even now as a beginner, you cannot be 100% correct. So you have to keep improving and bringing yourself under control. What the stop loss also does for you is the fact that it helps you to discipline yourself. You know when to stop, you know when to continue. Okay, so always stop loss. And take profit tells you where you are going to leave the market. Grid control. Oh, I already made $5. It's enough. Leave for that day, and that's daily bread. Wait for another day. Take profits is very essential. So stop loss actually automatically close your trade when you are going against one price is going against you, and take profit closes your trade when profit has hit your target. So always have where you want to reach in the target. Don't aim too much. Don't aim too much for now. Don't aim too much. Just 1:2, 1:3, 1:4, 1:5 is okay for you at this moment. Not target 1:100 for now, 1:50. You don't need to target so much. 1:20, 1:25, you don't need them. 1:5 maximum for now. Target 1:5 and go and sleep. So stop loss, we've talked about pips before, that is actually the change in price movement, right? The smallest change in price movement. Now, if I buy at 1.1000, stop loss will be below. In the next class, or subsequent classes, we're going to know how to set stop loss, where to set stop loss. Now, when you are buying a market, your stop loss is always below your entry. So just take note of this one, that when you are buying market, stop losses is below entry. Okay? When you are selling market, stop losses is above your entry. So if you check the price here, you see that currently I'm buying at 1.10000. That's about 1.1000. If you see that the SL here is 0950, that means the number here, the 3-digit number is is the 3-digit number here is actually the 3-digit number here is lower compared to this 1000. That means the subtraction of 50, right? So that means as you are buying market, your stop loss is actually subtraction. It stays below. You will subtract it from your entering position. This is your entry position, okay? But if you are selling market, you are adding your stop loss to your entering position. So your stop loss is always above your entry. So that means you know that when you are selling market, you know that market is actually coming down. So if market is coming down, if market is coming like this, right? And I entered market here at this point here, at this point here, I want to put my stop loss at this place for sell, for sell. But if it's a buying market, where I buy market, market is going like this, it's going like this, right? And let's assume I enter market at this position. Okay, that's when I enter market at this position. I want to put my stop loss below here. I want to put my stop loss below here. That means I'm subtracting the distance between here and here, which is what? My peep, like we discussed earlier, that's my peeps. So you put your stop loss there, and that is how price goes. So we've talked about risk to reward. I told you that target at least 1:2 or 1:3. It helps you to grow your account with fewer winnings of trades. So excuse me. All right. So and that is the same way 1:3. You don't do 1:1 or 1:0.8. Don't let your stop loss be wider than your take profit. Don't say I enter market here. Let's say I enter market here and I put my stop loss here, and here is now my target. That is poor trading. You are not a trader. And with that one, you are not a trader at all. You are just gambling. So don't let your SL and stop loss be, or your SL and TP be the same thing. So types of trade execution. We have instant executions. We have limit orders. Those are two types. Another limit orders, we have a buy stop, sell stop, buy limit, and sell limit. I think let me get to my chart so we can actually see this one, explain this more a bit. We're talking about instant execution. So we're talking about the fact that you have to sell market at the current price that market is. At the current price that market is. So looking at what price is currently now, you can see this is gold. Wait for my price to load. Okay, good. So my price has loaded now. Let me go on a lower time frame. Okay, so market has actually closed here. But okay, let me see. Okay, sure. Now, if we look at where price is currently, right? Now, this is 3,324. So, assume I want to sell the market, right? I will not, and at this current price, where price is now, I'll just press sell on my MetaTrader. On my MetaTrader, that is instant execution. That's instant execution. I just press sell. I came to the market, I see price, and I say I like it where the price is, and I buy immediately. I do not negotiate further. That is instant execution. Okay, but on your limit orders like the buy limit, like buy limit. Sorry, 1 minute, please. Okay. Now, the Amazon price is actually going this way. Right now, market has been buying. And I feel like I cannot wait to buy market at this point, at this top. I want price, I believe that price will still come down, right? Lower here, which is very, very true. So I will wait for price to come here and set what is called buy limit. I'll set what's called buy limit here at this point, such that when price now come from this top to this low, price will automatically pick me for a buy and then continue to go up. That is buy limit. That is buy limit. But for, and at that point, my stop loss, don't forget, my stop loss will be, once I enter, put a buy limit here, my stop loss will still be below the lowest low. Okay, my stop will be below the lowest low. I'll set my stop loss here. That is buy limit. Buy stop. Now, market is buying. Please note the difference between buy limit and buy stop. Market is buying, right? And I felt like this price, I'm contemplating if this price will still continue to go up. Maybe it was currently at this place, at this 3308.323, and I felt like market will still go up, right? But I don't want to just enter like that. I can now come here, I can come here above this up, because this is a resistance zone, and I come above here and put my entry here and put buy stop. Meaning that I'm telling the market that price, so when you get to this location, activate me for a buy. And once, if market definitely get there, it will definitely activate you for a buy and continue buying. That is if it's still going in your direction. Please get the condition. That's if it's still going in your direction, because you can sell buy stop and market can reach this zone and buy a bit and be selling down. That means at that point you are running loss. That means you have done a wrong analysis. Now, for sell limit means that market is just the reversal of buy limit. Market is actually selling. Market is coming down, and I feel like the price will still continue selling. But I don't want to actually join anyhow, right? So I can just place my price, sorry, a sell limit above here. Okay, but market is here, and I say market should come back and pick me at this point. Market should come and pick me at this point, and then sell, go down to my direction. That is sell limit. Why sell stop also means that market is actually currently in a sell trend or a buy trend or sell trend, and I felt like the price of market is still going down, but I don't want to just join, so I can place market here. I can place market sell limit here, sorry, sell stop here, and market will come and pick me for trade and then continue in my direction, and it can also come and pick me in and continue in opposite direction. That means I've traded or I've analyzed the wrong way. Please know the difference between buy limit and sell limit and sell stop and buy stop. So one is instant execution, while the other is instant execution has to do, like I said, you are buying the market immediately, while um, pending orders or limit orders, they are what you wait for the price to come and pick you in at those positions. I guess that is clearer, right? So, trading psychology, you have to stick to your plan. We'll be doing a lot of strategy buildings, we're going to be learning a lot of things over the period of time, but you must stick to your plan. Whatever you learn is what you should stick to. Avoid over leveraging, like as I've talked earlier. Don't let greed allow you to open multiple positions. Stick with one position. Don't use big lot size because you want to make big money. Those are things that actually kill traders. You want to make money fast, fast. You will lose, you will end up losing. The market does not fucking care about your emotions. They don't care about how much you have in account. They only want to know if you understand the rule and you play the rule. So then another thing is you should accept losses. Accept loss. You know, traders, there are traders that want to revenge the market. Once they make loss, they want to revenge the market. They want to like, let me win back my loss. And by trying to do that, they are not emotionally stable to analyze the market effectively. And they end up chasing the market and market end up chasing them out. So then avoid emotional trades. Emotional trade has to do with the fact that you just jump into trades anyhow. Oh, this market is going this way, then I sell. You know, when I tell some people say that when they buy the market is when they sell the market, so the market will sell. When they sell the market is when the market will buy. You feel like, is it your village people that are doing you that way? No, no village people is doing you that way. It's called emotional trading, because you not come down to actually analyze the market and read the market the way the market should be read. You just feel like village people are following you. Village people are not following you. You are the one following yourself, doing yourself. Relax your emotion and you will enjoy how to trade. The most important, protect your capital over profit. I think there's one favorite quote I like so much. The fact that he said, not trading is also a trading decision. So if your capital is still protected and you don't make profit and you don't make loss, it's better than losing the money. So keep your money to yourself. Protect your capital like your life. If you lose it, you cannot collect it back from the broker. The only way you can collect it back from the broker is to calm down and analyze market very well, stick to your plan, avoid over leveraging, and then follow the trade as it is. So I think we've come to the end of today's class, and it's beautiful taking you all through this period. It's been fun over 30 minutes or so. So take these are assignments, do this assignment and get back to submit on the group for assessments. If you have any questions, you can comment on the comment sections, is opened, and at the same time you can also ask directly on the WhatsApp platform and we'll respond to you immediately. So do have a great, don't forget to subscribe. Remember, don't forget to subscribe. Please subscribe, subscribe, subscribe. Subscribe, share to friends. Now we have made this public. Share to friends, help us to reach others, help us to reach people, help us to impact more life with our classes. Thank you and do have a great day.